Hello, everyone. Welcome to our training today. Today, we're talking about real estate financing. We're talking about how to get the money you need to invest in real estate. Look, now's a great time, okay? Right now, with COVID-19 happening, is a great time, especially with all the foreclosures that are about to happen in the months to come, to jump in and to be able to come in and actually make some money on owning and flipping real estate. Today, we're talking about how to do that with real estate financing. We're talking about a bunch of different options that could work for you to actually be able to come in and invest in real estate property. So for those that don't know me, my name is Ty Crandall. I'm the CEO here at Credit Suite, and this is what we do at Credit Suite. We help business owners get capital. So if we can help you along the way with getting money to invest into a real estate business, feel free to give us a call, 877-600-2487, 877-600-2487, or you can get approved on the link at the bottom of our slides, creditsuite.com/get funding. And Denisha, thanks for coming in and saying, hey, I appreciate it, from Facebook. So look, it's expensive to be able to flip homes, right? It takes a lot of cash. It's cash intensive is what we call it, because you got to have the money to buy the property. Then you have to have the money to do the rehab and flip the property if you're going to do a fix and flip. Okay, you might want to do a buy and hold. Either way, you're still going to need to do improvements on the property and still need the actual cash to be able to buy the property, okay? And there's a lot of labor involved as well, right? So there's a lot of things that you've got to pay for, a lot of unexpected repairs. If you've ever, a lot of people getting into flipping homes because they see people doing this on TV. And if you've ever seen the people doing it on TV, what you see clearly is that it oftentimes is way more expensive than what they intended. There's a lot of surprises that cost a lot of money. And the reality is, when you're just getting started, you need to have the capital you need to be able to do this successfully. Yumaine says, I'm excited, Ty. Thanks for coming in from YouTube. Peter, thanks for coming in from Facebook. So you need house reseller financing. And that's basically an overall term that's used to basically get the money you need to fix homes or to buy homes and then fix them and then flip homes, okay? You're not dipping into your personal savings. You're not using your personal credit. You're not going to be kind of a victim of these highs and lows of you buy a house, you spend all your money to buy the house, and then it's the repairs are higher than you expected. Then you can't sell the house. We don't want that to happen. And it all comes down to actually being well capitalized, having the money that you need to actually do this. So a lot of different options we're going to talk about today. A lot of kind of business financing, a lot of other things that you want to consider. One of the things that you want to consider is a home equity line of credit, or a HELOC. Look, I have used my own equity in my home before too, and I'm not saying it's a good or bad idea, right? It depends on your own threshold level of risk and what you're comfortable with. But the first business I ever started, I leveraged my home, got a home equity line of credit, and used it to start the business. And because of that, I was able to build a 7-figure business pretty quickly within the first 2 years. So this is a great way to go, because you can leverage your existing home, and there's a couple different options you have here. You can leverage your existing home to get a home equity line of credit, buy the property, use that HELOC for the maintenance or for the actual repairs, and flip the property if you feel like you're getting a pretty good deal on the property and you could do what you need to do to flip it. So this is a great option. Now, you can also come in and get a HELOC on the property you buy as well after you buy it. Now, that's a little bit more problematic because home equity lines of credit are not popular or common on investment properties. They're very popular and common on primary residences. So you could tap into the equity of your primary home, an asset or that you could have that serves as collateral, to be able to get a HELOC, sometimes get a HELOC in investment property, but you're not going to get a high loan to value with that. Meaning that if you get a home equity line of credit on your primary home, you might get one up to 90% of the total value of the house. That's how much you could borrow against the total value of your home. But on an investment property, the problem there is that you can only maybe get 50-60% home equity line of credit if you can get one. So you're not going to be able to leverage 90% of the value of the home, but it is possible to do on investment properties as well. Okay, so again, you could tap into one, get at least 20% equity in your house, go up to an 80% loan to value. Sometimes you can get as high as 85-90%. 80% is pretty common with a home equity line of credit. So let me give you some simple math. You have a $100,000 home. You owe $50,000 on it now. You can get another line of credit for $30,000 to total 80% of the value of the house, or $80,000 in this example. Again, you can get as high as 85. I've even seen owning a mortgage company as high as 90%. The 80% is typical, but you can expect to get up to 90 if it's a primary home. Okay. If you own a rental property, well, then you may be able to take advantage of an investment property line of credit against that as well. As I mentioned, using the property as a line of credit, or using the property as collateral to get a line of credit. A couple of different ways to do this. You can do it with one investment property you have, or some lenders will even do blanket loans, is what they call them, where you're able to come in and take a basically, I can't even think about the word right now, but you've got 3, 4, 5, 10 different properties you own. You put them together in one pool, and then you can get a line of credit using all of those. So 2 different options there that are possible using investment properties to be able to get lines of credit as well. So to qualify for an investment line of credit, you have to have good to excellent credit. You need to have a history of successful real estate investments. And generally, you must own the property for 1 year or more. Now, this isn't the case with a home equity line of credit. Your primary home, you can get a line of credit against a HELOC pretty quick. An investment property, they're oftentimes going to want to see you own the property for a year to get a HELOC, and you need to have good credit with either one of them. Home equity line of credit, HELOCs require good personal credit. It's actually easier to get a regular mortgage on a home than it is to get a HELOC. So you really need to have very good personal credit to get a HELOC, or somebody signing as the actual guarantor and borrower that does. But if so, it's a really good option to go if you've owned the investment property for more than 1 year. Now, speaking of lines of credit, if you're an experienced flipper and have a history of doing deals, another option is a business line of credit. With a business line of credit, you can access a line of credit basically using your revenue in your business as collateral. So if you have a legitimate flipping business already, if you're not just getting into this, if you already have it, then there's a lot of banks that don't look highly on or a real estate company, real estate investment companies. But there's a lot of them that do. And so the reality is that you could use your business itself as leverage to be able to get a line of credit. You have 2-3 years with the tax returns. You have good personal credit. If your cash flow looks good for your bank statements and tax returns and you have good personal credit, you could use the business itself to qualify for a business line of credit. And Jawan says, hey, Ty, hey, thanks for tuning in from YouTube. So business lines of credit are especially useful for home flippers because you can use it again and again and again. Okay, so another option is just to tap into it when you flip. Okay, but you generally need to have excellent credit to do that as well. So I'm talking about HELOCs for a lot of reasons here. And I'm talking about lines of credit using your business revenue as well, because lines of credit you can use and reuse. Okay, I'm going to talk about loans today too. But if you get a loan, you have to qualify for the loan, right? Then you use it for the set purpose, and then you sell the property. Then you got to qualify for another loan for the next property and another one. So the bottom line is, if you're using the property as collateral as to debt for the debt, or getting some type of mortgage, using the property as collateral, the problem there is that you get a loan, you qualify, and then you have to get a loan every time you buy a property. With lines of credit, you get it once, and then you could tap into that line of credit and use it again and again and again for multiple different reasons. That's why lines of credit makes so much sense when it comes to house flipping. So with this approach, you can work with a seller to come up with a payment plan, and this is something called seller financing. So you basically, with this approach, work with the seller to come up with a payment plan and to create a contract. You make payments directly to the seller on an agreed upon schedule based on a price you both set with interest, but it's not regularly available. So I have I have real estate coaches that charge people $20,000, $25,000 or more to coach them. And this is the method that they teach. It's seller financing. So what they're doing is they're going to find people that are in trouble typically. So what they'll do is they'll go to a person that is behind on taxes, as an example. And they'll go to that person and they'll say, hey, look, I'm going to finance the house from you. I'm going to catch the taxes up. If you're behind on the mortgage, I'm going to catch the mortgage up. And then moving forward, I'm either going to finance the house from you, or I'm going to take over the mortgage and I'm going to pay it. So that's definitely something you could do. So in Florida, this is very common because it's a transient state. A lot of the people buying properties down here are moving in and out, and they live in other countries, other states, and they're investing in properties down here. So what they'll do is they'll come in, somebody will find people that are behind on tax records. They approach you and say, hey, look, I'm interested in buying your house. And sometimes what they'll do is they then come in and they say, okay, look, I'm not going to get a mortgage. I'm just going to finance it from you. How many months behind are you on the mortgage? How far are you behind on the taxes? They pay it. They catch up. They pay the person's mortgage, basically assume the mortgage, and then they pay it that way. Or another way is to go to the seller and just pay the seller, work out financing with the seller where you're paying the basic seller instead of the bank. So you're paying the seller for the property, you work out a note, you work out an agreement. And like I said, there's an entire vertical of real estate in flipping that takes place this way, where there's no money exchange. You're just signing notes. As a matter of fact, I know people in this space that all they do is do these notes and then sell the notes to flippers. That's what they do. They go find people that are in some kind of distress. Typically, it could be anybody, right? But people that are in distress are have a little bit more urgency to do this. Then what happens is they come in, they do a note, they agree to buy the house. then they have enough equity and room there based on what they agreed to buy it for and what it's worth. Then they go to actual people to do the fix and flips, and then they make a little bit of money. They sign the contract over to them, and then they move on. And all they're doing is out there finding people in distress, signing contracts, making sure there's enough equity, bringing in somebody to do the fix and flip. And then ultimately, there's really no money exchange there. And all they do is get money from the person doing the fix and flip, and all is set, all is well. So that's a great option to go as well. Seller financing, again, poses more risk, especially if you are paying if you're paying the seller and not the actual lender itself, because there's a risk that they may not pay the mortgage. You're buying the house, you're paying them, they're paying the mortgage payment supposedly, but maybe they stop, even if it's in violation of your contract. And often these are higher interest rates, but if you're doing a fix and flip and trying to get in and get out quickly, the interest rate really doesn't matter. You're not going to pay a substantial more in payments over 6 months, even if your interest rate's 2-3% higher. You can try bridge loans as well. Bridge loan can cover the gap between when you want to buy a property and when you can secure long-term financing. It can help cover the cost of the down payment on your next flip. And then you can focus on finding other financing as well. So bridge financing in the financing world altogether, consumer financing, commercial financing, real estate financing, it's all the exact same thing. It bridges the gap between something. And typically the gap is where you are now and where you're going to get other kinds of money. Okay. So that's what bridge financing is. It can give you short-term money until you get longer-term financing. But why I bring this up is that sometimes bridge financing is enough for you to actually be able to buy and fix the flip. The term is so short that you have enough time to buy it and use it to do the fix and flip. You never even need long-term financing because you're able to get out of the property in less than 6 months. Okay, bridge loans are generally secured by collateral, so you can qualify for a loan with lower interest versus some other financing. They're often easier to qualify for other loans. Usually the collateral is the real estate. Usually with bridge financing, the collateral is the real estate. And if you have other things you want to pledge as collateral, well, then that'll just mean that you need to put less money down when you actually purchase the home. Okay, cash out refinance as well. This is a financing strategy where you're refinancing an existing property you own and then taking the money out to actually do a fix and flip. We do these all the time. You can do it with a primary home. You could do it with a secondary home. You could do it with an investment property where you have equity in the home. And so we have some people that actually come in and they buy a property with cash and then they run out of money. And so then what we help them do is actually get with a mortgage professional that does a refinance on the investment property, the second home, and the primary home. And then with that, they're then able to come in and be able to basically get what they need long-term. Okay, so this is a great way to go because they're able to refinance the property that they have. They're able to get the cash they need and use the cash for the other purpose. We see this happen a lot with people that own a bunch of investment properties, they own free and clear, run out of cash, and want to use the money in those properties to be able to buy more properties. And this is also where bridge loans, it's where blanket loans come in. It's where refinances, where they can sometimes do a loan where they take the cash out of multiple properties at once. A lot of different options along this line. So for cash out refinance, you need to have 30-40% equity in your home. Otherwise, it's not cost effective. Look, the reality is if it's your primary home, maybe you're going to cash out to 80% total loan to value. And again, loan to value is the amount that you owe versus how much the home is worth. If a house is worth $100,000 and you get a loan for $80,000, that's 80% of the 100. That's an 80% loan to value. So typically on a primary home, you're going to do a cash out max at 80% loan to value. On an investment property, max, you're going to be able to cash out at 65-70%. That's it. That's all you're going to be able to do. And again, rates are way higher on investment properties or second homes because people are more likely to default on investment property than they are a primary residence. Okay, try a permanent bank loan, online mortgage for house reseller financing. If you want to buy a home that you can stay in for 5 years or more while you renovate it, well, then a regular mortgage with a fixed interest rate from a bank or credit union might be the best idea. So to qualify for lower interest rates than you get with other financing options, you have up to 30 years to make the payments. So look, if you're going to buy a home and rehab it while you live in it, which is another option people use, it's pretty smart. They go buy, I'll give you an example. Some friends of mine bought a beautiful property on a lake, beautiful lake, lake view they didn't have because this property was trashed and they had trees, so you could even see the lake. It was so covered with brush. And then what they did was they got a regular mortgage on the home. They basically live in the house while they were rehabbing, and they fixed all the inside to make it what they wanted. Then they started, fixing the outside, removing the brush so the lake view was there. The house was worth considerably more than what it was worth. And the minute they rehabbed it, they had it reappraised, and then they got a home equity line of credit against it. So they bought the house with little money down, then they fixed it up, made it worth a bunch more money with a regular mortgage, then got a home equity line of credit, then ultimately ended up selling the home for a good profit. So that gives you kind of a path or a mindset of what you could do. Bought the house, lived in it, rehabbed it while they lived in it, then got it appraised. It was worth a bunch more money, got a home equity line of credit, then use that to purchase another investment property while they were working on selling the property that they were in. What's nice about this right now is that you can get sub 3% interest rates. You know, if you're buying investment properties, you might pay 6, 7, 8% interest. You could get a primary residence mortgage like this for 3%. So a half or a third of what you pay for an actual investment property. Now, you must have enough money saved for a down payment, good, excellent credit to be able to get a home. You don't. If you're looking for a primary mortgage right now, you can get approved with a 620 FICO score. You can get approved with 5 to 10% down. Okay, you can get an FHA loan with 3% down for it to be your primary home. You're not going to get money you need to rehab the house using this, but I'll talk to you about that because there's other ways you can get the money to rehab the house. You could use this to buy the house, and another option we're going to talk about today to refi or to be able to get the money you need to actually do the fix part of the fix and flip. Now, if you're an experienced investor who has completed a few flips or have poor credit, well, then there's other financing available, including hard money loans. So the hard money loan, you're working with private investors, non-bank lenders. These can be individuals, online lenders in order to get the money that you need. Okay, they have less stringent underwriting guidelines, and you can qualify even if your credit isn't the best. Okay, but you're going to pay higher interest rates and you're going to pay more money down. Okay, so I was talking to a very good friend of mine, one of my closest friends, owns a very successful mortgage company down here in Florida. And I was talking to him about somebody else that needed a loan yesterday. I was texting him back and forth. And this person's able to get in with a 20% down, even with the current foreclosure. The person's currently in foreclosure. And with only 20% down, they're actually able to work with a hard money lender and get an interest rate of 5, 6%. That's not bad. 6% interest rate, 20% down, and the house that they're currently living in is in foreclosure. So hard money isn't bad if you think about it. But, you know, then again, if you compare it to a primary mortgage, if I got a primary mortgage on a primary home, I could get in with 3% down and a 3% interest rate. Way better than 20% down with a 6% interest rate. But still, hard money is a great option to go. Interest rates are still so low. Hard money lenders oftentimes offer what used to be a good interest rate 5 years ago, 6 years ago. They have to be that competitive because current interest rates are so low. Now, another alternative is our credit line hybrid program. And with credit line hybrid, you're able to get up to $150,000 in no-doc financing, 0% rates for up to 18 months. It helps you build business credit because a lot of these accounts report to the business credit reporting agencies. And all you need to qualify is good personal credit. That's it. All you need is good personal credit. Okay, if you have good personal credit, then you're able to actually get approved. And if you don't have good personal credit, you're able to use a guarantor that does. The reason I recommend this is that this is the #1 program for real estate investors that we work with. And as a matter of fact, if we look at the top 5 industries that we service, that we help get money, real estate agents and real estate investors are 2 of the top 5. So we work with a lot of people in real estate. And I can tell you that overwhelmingly 8 out of 10 of our real estate investor clients use this program. And there's a reason for that. It's lines of credit. So you're able to pay them down, use it for what you need, pay them down, and then reuse them. We talked about the benefits of that earlier. 0% interest for 6 to 18 months. So if you're buying this and using this initially for your purchases, you're paying no interest for 18 months. You could do 3 flips at 18 months at 0%. You're borrowing the money you need at 0% and getting multiple flips in during that time. And you're building business credit for your business, which will help your business get more money as well. And you can, all you need to qualify is good credit or a guarantor that does. Even if your credit sucks, you can find somebody else that wants to be part of the deal that has good credit and use their good credit as well. Okay, so hopefully that's a good benefit for you. Now, somebody says it keeps freezing up. Yeah, hopefully we're going to get through this today. I got a message of low bandwidth, but my internet, everything else, speed check test worked okay. So hopefully we'll be okay. And Earl says, good afternoon. Do you have any training modules or option on subject to real estate deals? Thanks in advance. We don't necessarily yet, Earl, but I'll add that to our list of topics to potentially cover. Okay, and the hybrid credit line program, again, you don't need it. You can't have any derogatory items on the credit report to get approved. But as long as you have good personal credit, even if you don't have revenue, even if you don't have collateral, you can still get approved. They just want like less than 6 inquiries in the last 6 months and like under 40% utilization, you can get approved. Okay, so build business credit is good as well. Okay, a lot of our clients use business credit to buy the stuff they need to rehab the property. So let me give you an example. A lot of our clients use real estate credit line hybrid to buy a property. Then they use business credit to get a Lowe's account, a Home Depot account, an Amazon account, and they use Lowe's and Home Depot to get all the stuff they need to fix the house. This is a smart use of your money. Instead of getting all the money you need from one place, no matter which of these options you look at, credit line hybrid makes sense to add to your arsenal. Because remember, think of it like this. You could use credit line hybrid to get the 20% down you need for the mortgage, to get the 25% down you need on the hard money. This is the smartest way to be able to get money for any business. Okay, it's not getting a loan for everything you need. Everybody tries to do that. They try to go get a $500,000 line of credit. But that's not the smart way to do it, because getting a $500,000 line of credit is really hard. A bank has a lot of risks there, so they really scrutinize the application. The best way to do it is for you to actually be able to come in and be able to actually use multiple forms of financing. So you use a mortgage, one of these options we talked about, a hard money loan to buy the property, but you need 30% down. So you get credit line hybrid, you take the cash out, because you can take cash out at 0%. You take the cash out of credit line hybrid. These accounts report on your business credit reports, right? So nobody on your personal credit sees that you're maxing out credit cards. Then you use the cash to the hard money lender to be able to buy the property. That's a smart use of money. And because even if your credit's bad, even if you can't verify income, you'll still be able to get into a house with 30% down. So you use this to get the 30% down, then you go use another option to be able to get the rest. Then you use business credit, Lowe's, Home Depot, to fix up the property. That's very smart, because you're using multiple different forms of financing to get everything that you actually need, okay? And I will talk a lot about it, but remember, business credit scores are all about paying your bills on time. You can get this without a personal guarantee. You can get this without a personal credit check. You can get this without cash flow, without collateral, without good credit. So anybody can get business credit. And it's a great way to go, because if you're going to do fix and flips, even if you're going to buy and hold, you need to maintain those properties. You need to buy stuff to flip the properties. Business credit gives you all that you need to be able to do so. And I'm not going to walk you through the steps of getting business credit, but I'll just tell you, you start with vendors, okay? And then from vendors, you move on. And we've got a lot here, but we're going to cover business credit tomorrow. You move on to places like Granger that'll give you actual credit when you have none. Okay, then you move on to places like Uline that will give you credit if you have none. They all have about the same requirements. As you can see, you have a bank account, DUNS number, address, EIN, set up with the Secretary of State. Again, we're going to dive into business credit more tomorrow. And then you want to get vendors that can even help you do what you're trying to do, like Hardware Express. So Hardware Express gives you a net 30 account that report to Experian. You need to have a DUNS number, you need to have an EIN, you need to have a business bank account. But you can get approved for them, and they have a lot of stuff that you can use to do fix and flips. Okay, and then you can be able to come in and get store credit at almost every major store, Lowe's, Home Depot, all the major retailers, Amazon, all the stuff you need to do the fix and flip. Okay, and then you're able to get Visa cards, MasterCards at the end of this as well. This is such an essential part of being able to do real estate investment, because you're able to do all the repairs you need on your corporate credit cards. Your business credit gets much better. Your limits get higher. It doesn't affect your consumer credit. And it's a great add-on to any of these other primary options we're talking about to buy the house. Like I said, think of it like this. Use one or two kind of financing combined to buy the property. Then come in from there and actually use something like business credit to do the fix part of the fix and flip. It's a smart way to do it. Also, there's house reseller financing. And this is a financing that's used specifically for the purpose of buying investment properties, okay? It's called fix and flip financing. It's called house reseller financing. It's called rehab financing. And what you could do is you can get 100% of the money you need to buy and repair the home, as long as the value or what you're borrowing doesn't exceed 65% of the after repair value. And we'll talk about that here a little bit further as we go. So they're going to want you to have some experience flipping homes, about 2-3 homes. You're going to have cash for this. They're going to want you to put money in escrow. Again, think about combining products. If you use the credit line hybrid to get cash, you could qualify for this, put that cash in escrow, prove yourself, and then get 2 or 3 more of these, and they're going to want less and less cash the more you prove yourself. Plus, you can also do these loans with multiple different properties at the same time. You can go to our group of investors that do house real estate, reseller financing. 640 FICO is all you need to get approved. So average credit, some experience, and they will come in and even do 2 or 3 projects at exactly the same time. Now, this kind of financing is specifically for the purpose of flipping real estate. Okay. Again, you're going to need to be liquid. They're going to want 20, 30 grand in an escrow account. They're going to want to have some experience. They're going to want average credit of 640 or higher. But if you have those things, then there's a good chance that you're able to actually get approved for this. And it's a phenomenal product because it's specifically for flipping homes. It's a 6-month loan, very low amount of interest. The investors, once they feel comfortable, will do all kinds of additional properties. You can use credit line hybrid or these other options we talked about to get the cash you need to get in the door. And once you've done a few flips, these guys will give you money like it's going out of style. Now, they say it's hard money rates, but it's like 8% interest. So I guess compared to a primary mortgage at 3% is high, but 8% interest if you're flipping the home in 6 months, you do the math. You're not spending a lot of money to the actual lender to be able to get this kind of financing. A lot of real estate investors use that kind of financing to be able to actually initially get into their first handful of flips after they've done a couple and got a couple under their belt to prove that they can do it. Now, lender-wise, again, lenders will typically do a 6-month loan, no prepayment penalty, so you can pay it off early, and they'll give you as much as 65% of the after repair value. So let's do some math on this. So let's say you buy a home that is going to be worth $100,000 after you fix it up. Well, then you're able to get as much as $65,000 or 65% of the after repair value, what it's worth after you fix it up. So if you buy the home for 50 grand, well, then you're able to get 100% of what you need from this program. You get a loan for 65, you get 50 to buy the house, you get 15 to do the rehab and repair, you sell the house for 100, and then you pay off the lender and you pocket the rest. So you can get 100% of the money you need to buy and rehab the house as long as the after repair value, what you're buying for, the after repair value doesn't exceed 65%. So you have to buy the house right in order for this to actually work, okay? But again, 100% of the funds you could use to basically buy and rehab. It works kind of like a construction loan. So you get the money to buy, then you get the rest of the money in phases as you accomplish certain things, just like you typically would with a construction loan, okay? 8% interest rate or higher, loan starting at 25 grand. You can get funded an application to funding in about 3 weeks or less. I think my dogs see somebody outside, so don't mind the dogs. If you hear the dogs barking in the background, that's what we all get working from home in COVID, right? So again, a lot of different options, loans up to $2 million, average credit works well, a great program to be able to do this. So a lot of things we've talked about here today as we kind of go through and do this recap. House Reseller program, a lot of different options, depending on your credit score and depending on your experience. Okay, you're able to come in and you're able to do a primary purchase using a mortgage. You're able to work with hard money lenders if you have a greater percentage of money down. You're able to do a cash out refinance against your primary home, a cash out refinance against one investment property or multiple together as like some kind of blanket loan. So you're able to do all those as well. You're able to get a home equity line of credit on a primary home or investment properties or second homes. You're able to use credit line hybrid to actually get the cash you need to put down on these other options you have. You've got business credit to actually be able to do the repairs, the maintenance, everything like that. And then you've even got a lot of other options too, like seller carry, seller financing, where they're holding the actual mortgage, where you're buying distressed properties or having them hold the note while you do what you actually need to do. So a lot of different options that you have there. As a matter of fact, I even have people that come in and buy properties from a seller because the seller's not able to sell the property, and then they lease it and rent it out for the seller using Airbnb, and then they pay the seller a large percentage of what they make. So the seller covers their mortgage and makes a profit, and somebody else manages the whole deal. So with Airbnb, there's a lot of interesting things that you're able to do like that as well. And then don't forget about seller or about house reseller financing as well. Because with house reseller financing, you're able to come in and actually get financing for the purpose of rehabbing, fixing, and flipping homes and get 100% of the money you need to do so if you have a couple under your belt. And again, I've given you so many options today that you can use to get the couple under your belt. Then you move right to credit. Then you move right to the house reseller program, the fix and flip financing. Once you've proven yourself, and they can take you from there. They'll give you all the money that you need if you're buying the property right. So if we can help you along the way, give us a ring. We never charge fees to help you. What we do in these cases is we're going to refer you to a mortgage broker, refer you to somebody that can do a blanket loan. We've got people that'll help you take the cash out on a business loan of your home. So we can refer you to people that can help you in those kind of areas. The house reseller program or the house fix and flip financing, we've got sources for that we can get you to as well. So if you need help along the way, give us a ring, 877-600-2487, or get approved at creditsuite.com/get funding. And if you like this, then don't forget to follow us on social. Our social media channels are on the top right of our page, creditsuite.com. We go live on Periscope, YouTube, and Facebook Tuesday and Thursday at 11 o'clock Wednesday, all Eastern time. We have daily tips on Instagram, Twitter, and even a podcast you can listen to on the go. So thanks, everybody, for tuning in. Thanks for all your comments. If you missed this, then go back to the social platform that you're watching on now, and you can see the video in its entirety on Facebook, Periscope, and YouTube. And I look forward to seeing you tomorrow where we're talking about business credit. We're talking about how to be a hero building business credit. And by that, I mean, we're going to talk about all kinds of business credit cards you can get for your business, where there's all kinds of cool things happening with charities. So if charity is important to you, like it's important to me, then you're able to get credit cards. And then what you're able to do is actually get points and then give money back to charities, all kinds of cool things most people don't know about. So we're going to be diving into that topic as well. And Yumaine says, you're great. Thank you. Russell says, thanks. Thank you all for tuning in. I will see you tomorrow, Wednesday at 11 o'clock Eastern. Thanks, everybody. Don't forget to like if you got value from this video and subscribe. Thanks. I'll see you.